Hi, I'm Robert Maltby. This is Maltby's Minute on the Market, December edition. Getting ready for Santa Claus. Market acting quite a bit better. We're going to look at the 7 hegemons. Some call it them. We did, as we coined the term back in March. The Magnificent 7. That would be Google, Apple, Nvidia, Amazon, Meta, and Tesla. They're also 7 of the largest investors and lobbyists on K Street. No coincidence. And as we progress towards the immense opportunity in AI, it looks like these 7 companies are also primed to dominate that. So that will be interesting to see how this unfolds. So many are afraid. Many see this as the next big thing. Anyhow, into the market. We are still bearish, although we've had quite a stiff rally. We believe it's a bear market until the Fed gets out of the way. Our market indicators are all nearly positive except for the Fed. The technical and earnings indicators are leading the way to the bullish camp. This is outweighed, though, by sentiment, monetary valuation, and liquidity indicators. Liquidity is now turning more positive. Excluding the Magnificent 7, the S&P will be trading near about 22% lower, or about 3,700, vindicating many in the perma bear crowd. Year to date, as of the early part of December, the Magnificent 7 is up over 100%, pulling the triple Qs up 44%, and the S&P up over 18% at that time. Over the same period, the equal-weighted S&P 500 is up 3%, and the Russell is up 2.25%. Barclays aggregate bond index is down nearly 2%. Now, excluding the Magnificent 7, the weighted S&P 500 is down 5.4%, and the S&P excluding the Magnificent 7 unweighted is down 11%, with the microcap Russell down 6.7% through that period. Has this gone too far? Let's take a look at the key Magnificent 7 trading at a PEG ratio combined with other indices adjusted for earnings predictability. We find that Meta is the best value on this measure at 1.7, followed by Google at 2.0, our singular research coverage list at 2.0, Microsoft at 2.2, Nvidia at 2.6, and the historical S&P also at 2.6. The rest of the market, the not so hot 493 at 2.7. So we find that the many of the stocks in the Magnificent 7 are at a discount to the long-term valuation of the market adjusted for earnings predictability. Now the rest of our indicators. We find market sentiment is negative. It has shifted very quickly to overly bought. The trend and the AAAI Investor Sentiment Survey just jumped out of the ballpark to over 2-to-1 to the bulls, which is overbought and negative from a contrarian perspective. So all these indicators have been primed upon the CPI and the PC and all the Fed minutia alphabet indicators, which are showing that the inflation data is coming down and it's given rise to a strong barn market as well. So looking at the technical indicators, market breadth just recently firmed up on the 200-day, which we weight the most heavily. Of course, the 20 and 50-day indicators are overbought. So at some point, if we weren't in December, I would say we're headed for a short-term pullback. Our valuation indicators are negative. This is best portrayed if we remove the market cap weighting of the Magnificent Seven. We find that the PE multiple for the 493 is 15, about 10% below the norm. Earnings momentum, very positive. The ratio is expanded to 84% beats versus a 71% trailing 10-year average on that. Here's the problem. The Fed monetary indicators still negative. Now this could be changing. It's a slow development, but we want to be careful here before we go all in bullish. And until this indicator turns positive, it doesn't look like we'll have a bull market green light. Again, the Fed, it's a shutout with all of our indicators. Our excess liquidity indicator is very tight at negative 225 basis points. The 10-year yield spread, 4.25 of 10-year treasuries below high yield bonds. Most observers believe that the December economic data will continue to be deflationary, thus underscoring the belief that the Fed is done for the moment. So here's where we are. We've had a robust rally. The breadth is very much improved. Now for our stock of the month. The company is called Apogee, ticker symbol APOG, trades in the $45, $46 range. Our target is 56. The company is a manufacturer of architectural glass and metal glass. They also provide installation services. Their initiatives to cut costs are kicking in and yielding strong results. The architectural glass segment is well positioned for growth in commercial buildings, in healthcare, and technology. Their balance sheet very strong. Leverage ratio just 0.7. Free cash flow is estimated to be very high, about 75 million. We believe that the company should grow its earnings steadily for the next 5 years because of its positioning, combined with its low valuation because it is positioned in commercial real estate, and that's a sector where many participants are very negative. We see this company growing their earnings from about $4 this year to $4.65 over the course of the next 2 years. It is trading currently at about 11 times earnings with about 15% long-term growth. Thus, we believe it is a buy. Come to our website for a trial subscription at singularresearch.com. And ho, 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 may the Santa Claus rally continue, but let's not forget about the Fed in the background. Robert Maltby, Maltby's Minute on the Market.